Welcome back to Capital Ideas. I'm Nick Morgan, one of the co-hosts of today's episode and the co-founder of ICANN, Investor Choice Advocates Network. Capital Ideas is where we explore the amazing creativity of people and the capital ideas that bring these ideas to fruition.
I'm Mark Hiraide, a co-host of Capital Ideas and Senior Legal Director and Policy Counsel at ICANN.
And I'm Dara Albright, and I'm a co-host of Capital Ideas and a very proud board member of ICANN. And today we are joined by Mark Yusko, who is the founder, CEO, and CIO, Chief Investment Officer of Morgan Creek Capital, and one of the earliest, and I would say one of the smartest investors when it comes to transformative innovation. And Mark, if you've read Mark's X feed, then you will know that he has some of the most insightful observations when it comes to investing, especially in early stage innovation. And I like to call some of these Yuskonisms.
Very kind, very kind. I appreciate it, Joe.
So my two favorites were over the years, probably a fad, referring to Bitcoin's meteor rise. I also like math is hard, which always makes me laugh. But there are tons and tons of others. And, you know what? Well, look, when it comes to especially, I would say, the economics of crypto and innovation in general, for that matter, I think some of our legislators might be able to use a refresher in a basic math course. So
no, it's funny. In fact, I typed both of those phrases this morning, so I'm not very original. I do the same thing over and over again. But math is hard, right? And to your point, many of the people who are put in charge of many things, I think, could use not just a refresher course, but just an introductory course on, how math works, because magic is not an option.
Right. That is so very true. So I'm sure we're going to get into a couple of more Yuskonisms as we go on with this podcast. But in the meantime, Mark, welcome to the show. We're really excited to have you.
No, thank you. Thank you for having me, and great to be with you. And I love the platform and just the basic idea. Capital Ideas is such a great, wide-ranging topic, and looking forward to the conversation.
Yeah, and we're excited to hear your insights. And I thought maybe we could start. First question, I saw, especially when it comes to your X feed, and I recently saw one of your tweets. I don't know if we could call it an X or a tweet, but I don't know.
Look, I still call it Twitter. I'll never call it X. I still call it tweets. So go tweets.
SpaceX.
Right. One of your recent ones, you said, when it comes to investing, you said comfort is the enemy of performance.
Yeah.
I love that. And that actually gave me a lot of comfort, especially in these volatile markets that we're seeing in the crypto space for, in recent days. But I was wondering, maybe you could start off, talk a little bit about what you meant by that.
Yeah. So it has at its origins kind of where I got my start in investing. I worked for big universities as an investment guy, and, you have a board, and so, if you make a recommendation to the board, and what I noticed is they would approve about 95% of what we recommended, but the 5% they didn't approve outperformed the other 95 by a mile. And it wasn't because we were smart and they weren't. That's not my point at all. My point was that if you make an investment decision and you feel good about it, you'll probably do less than average because it's already in the price. The reason you feel good about it is everybody else is telling you how smart you are and how good an idea it is. If you feel really good about it, overconfidently good about it, you're probably going to lose a lot of money, because that's when it's super easy, because, oh, you're such a genius. And so it goes back to a true story. So I come down from my alma mater at Notre Dame down here in North Carolina, and first week go to the board. And at the time, you may remember The Economist magazine had a cover story, "The World Awash in Oil." And there were these three guys covered with oil and roughnecks. And I have this rule: if I hear it once, I remember it. If I hear it twice, I write it down. I hear it 3 times, I do something about it. And so I had seen that. I'm like, okay, I remember that. Well, 2 weeks later, cover of Business Week, back when it's called Business Week, Richard Rainwater, God rest his soul, one of the greatest investors of our age, on the cover, long $900 million of oil. Tore that baby out, put it on the desk. Okay. 2 weeks after that, I'm sitting down here in North Carolina, and three young guys trained by Richard came and said, hey, we're raising a fund to invest in oil. I'm like, ding, 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 ding. I go to the board. So it's my first meeting. I've been here, maybe a month. I go to the board. Like, all right, I want to give these guys 1%, and I want to take the allocation to energy to 5. We had 0. And my board chair says, Mark, that's the dumbest idea I've ever heard. But if you really want to do it, okay. I'm like, okay, great. Get to the end. He calls me in the chancellor's office, says, Mark, when I say that's the dumbest idea I've ever heard, that's what I meant. The other stuff was just to be nice in front of everybody. And the chancellor says, well, Max, we just hired him. So, we should try a few of his ideas. And if they don't work out, then we fire him. But if we're not going to try his ideas, we might as well fire him right now. I'm like, guys, I'm sitting like right here. And so what that aha moment for me was the fact that it made him so uncomfortable and it sounded like such a bad idea meant it's probably, and I wouldn't tell the story if it didn't have a good ending, right? That 5% that we did put in generated 25% of the endowment's returns for the next decade.
Wow.
And so what I talk about is when you feel really comfortable, the alpha's gone. When you feel really uncomfortable, the alpha is there. And the more uncomfortable you feel, the higher the alpha. And so I used to say my job was to maximize the discomfort of my board. But then I realized it's a little more nuanced. If you maximize their discomfort, they get rid of you because you're an irritant. So you have to optimize the discomfort. You have to keep them just comfortable enough that they do the things that make them squirm. So that's a long answer to a simple concept, but it really is important. And the other thing about this is you can judge the quality of an idea by the quality of its detractors. Right? So I, got exposed to digital assets in 2013. A good friend of mine, Dan Moorhead, we've been buddies for 30 years, called me up and said, hey, I'm quitting my job. I'm giving back all the money in the hedge fund. I'm going to spend the rest of my career in blockchain and Bitcoin. 2013, I was not running drugs on Silk Road. I was not a cryptography student. I had heard of Bitcoin, but I didn't really know what it was. Blockchain I got because I've been an infrastructure guy for a long time. I'm sure we'll talk about that. But I just didn't really understand Bitcoin. But when Jamie Dimon started railing against it, saying it was a fraud, the light bulbs went off. I'm like, well, of course he says that because his livelihood depends. And he's a pretty smart guy. Whether you like him or not, he's a really smart guy. So the quality of the detractor said that this was a really good idea.
Well, it's interesting, Mark, how you might be able to apply that observation of yours of investor behavior to legislators' behavior. And as you know, Congress is trying to solve the problem of, or answer the question, who does the SEC regulate? Who does the CFTC regulate?
Right.
What are securities when it comes to digital assets? What are not? The House has already passed a bill which they call the Clarity Act. The Senate is now working on its version for market structure legislation. And we noticed that you also tweeted that a better name for the Clarity Act would be the Regulatory Capture Act.
Yeah.
And so I wanted to ask you, what could policymakers be doing to create a more effective regulatory landscape for digital assets?
Whew, this is a big one. So now we're going to go into the sinister side of Mark. Look, if you look at incentives, you'll find behaviors, and we're not going to solve the main problem, which is we need term limits and we need to get away from lifetime politicians and we need to not let them do insider trading and all kinds of things that don't make any sense. But in this case, it's about incentives and about outcomes that I will argue they, meaning the legislators, shouldn't be able to legislate. So an example is, and I actually talk about this all the time, is so many people cheered when Bitcoin and Ethereum were labeled not securities. Might be careful what you ask for. You might have just got it, because that was not accidental, right? They made it appear like, oh, we don't know. No. That was intentional to make them commodities. Well, why? Well, wind the tape back. Leo Melamed, former CEO, now chairman emeritus of the Chicago Mercantile Exchange, 2017, says, don't worry about Bitcoin. We'll tame it. Like, whoa, that's a weird word. That's not a word I think we need in the lexicon. What do you mean? Well, just like they tamed gold and oil and all the other commodities, and the short version of the tale is, in the old days, let's say, Mark, you and I want to have an oil transaction. I actually have to have some oil that I own in order to give it to you to sell. But once futures were created, now I can write a contract and I don't ever have to get any oil. As long as we cancel the contract or settle up before the end, we're good. Well, wait a second. I just created a paper barrel of oil out of thin air? That's magic. And if I do that over and over and over, I can actually manipulate the price. And so it's been happening in gold for years. This JP Morgan, I love this part. I shouldn't name, but JP Morgan paid a $960 million fine without admitting guilt. Like, how do you pay $1 billion without admitting guilt? I don't really understand that part. For spoofing the price of gold. Well, what does that mean? Well, it means you're manipulating the price of gold in the futures market so the spot price doesn't change. And when they asked them, they said, well, how do you pay a $960 million fine and be happy? And said, well, we made $20 billion. That's just a cost of doing business. So again, long answer to your question, which is a really important question. When you look at the Clarity Act, the Genius Act, the first act, the Genius Act, everybody was cheering. Oh, yay, we have clarity on regulation. Yes, but look at what it actually did. It said, if you're Tether or your USDC, you're preferred. Well, what does that mean? What does preferred mean? Well, what it means is the government has an agreement that they don't like that account that owns some Tethers, so we're going to seize them. Well, that's what we're trying to get away from. We're trying to get away from sanctions and the dollar. And well, if they can walk into Tether's office and seize Iranian customers' Tethers, that seems like a centralized system that we're trying to move away from in a decentralized world. So the Genius Act, cute name, but maybe there's some things that are a little more sinister. Then you get to the Clarity Act. Now we've got this whole regulatory capture, which again, normal course of business. Most people have you've heard the term red flag. We've all heard it, right? Red flag. You know where it comes from, right? In New York, or New Amsterdam back then, in New York, I think it was called New York by now. So the automobile comes along. And the horse and buggy people didn't like it so much. So they, through regulatory capture, got the legislature in the city to pass a red flag law, which meant you had to hire a human to walk in front of your car with a red flag so the horses could see you coming. Now, I venture to say no one listening to this podcast has ever seen someone walking in front of a car with a red flag. It was a dumb law. But incumbents will do whatever it takes to stay in power. And so they will use regulation as a means of delaying the inevitable. So it's like the old, I guess it was Mandela quote, right? That he didn't say, but someone else said, but everyone attributes to him, which is, first they ignore you. So when Bitcoin was formed in 2009 until about 2015, bunch of nerds and geeks with your science project, whatever. Then they laugh at you. So 15 to 21, okay, nerds and geeks, ha, 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 ha. Well, then they fight you. So 21 to, I'll argue, 27, maybe 6, 7, maybe we're there. Then they fight you. Well, how do they fight you? They try to pass regulation that limits what you can do. They try to classify things in their system and structure, like you say, SEC versus CFTC. And let's call a spade a spade. Certain people, if it costs $100 million to become a U.S. senator, most people don't have that kind of cash. So they got to raise it. Well, if you have to raise $100 million, you probably owe somebody some favors. And so certain senators tend to favor certain industries. Logical. And so Ms. Warren tends to promote legislation that favors the banksters, as I like to call them. I probably shouldn't call them that, but and look, banks have had a good 848-year run. It's been awesome. But it's time for new technology. And, analog banking was fine. Electronic banking was better. Digital banking will be better, but it's just going to take time to evolve. Anyway, long answer. Sorry.
No, but a great answer. And maybe it leads, I don't want to do too hard of a pivot here. So trying to tie that answer to the next question, the regulators are capable of throwing lots of impediments in the way of newcomers.
Yes. Yeah. So then they fight you. Yeah.
Yeah. So you have been an outspoken critic of one of those barriers to entry, and it's specifically the SEC's accredited investor wealth and income restrictions.
The walled garden. The walled garden.
Well, wait, you can't. We actually went and found some of your tweets, and they are little gems. So I'm going to quote you back to yourself. You called the wealth and so for those who haven't been following this, the accredited investor rule, and I'm going to oversimplify here. If you don't meet a certain wealth and income level, you are effectively ruled out of many private securities transactions. Yep. So retail investors, by and large, are excluded from private securities transactions. That's an oversimplification, but we'll do for these purposes. So anyway, you tweeted once that these wealth and income restrictions are a walled garden protecting the rich from having to share the best investments with the rabble. They are protecting the elites from having to share the true wealth creation engine with the masses, and rules made by the wealthy to keep all the good it
will be presented as a protection mechanism to protect the consumer from the big, bad, meanie, Wall Streeters. That's a great sales pitch. Great. I'm trying to protect you. I know it's best for you. But here's the thing. What you're really saying, if you ain't rich, you ain't smart. And that's just dumb. I've met plenty of not so smart rich people, and I've met plenty of brilliant not so rich people. So I believe, and there's a lot of evidence to support what I tweeted, in that the rules are made by the people up here at the tippy top. They're not made by the masses, right? They're made by a small number of rule makers. You guys deal with them all the time. And incentives matter and compensation matters and all of that. But accredited investor standard is one where I just have to chuckle, right? So let's think about investing, just general investing. You either are a loaner or an owner. That's pretty much it, right? You either loan someone money with the expectation of getting it back plus a little interest, or you buy an interest in something. Very simple. Okay. From that, we have to take one of 4 risks. If we take no risk, we can loan our money to the federal government, right? Theoretically, no risk in treasuries. And 99.999% of the time, we get our money back plus a small amount of interest. The problem is that interest roughly equals the amount they steal from us through inflation. So we stay at the same level of wealth. So in order to get wealthier, we have to take one of 4 risks. We have to take credit risk, meaning we have to lend the money to someone beyond the government, corporation, maybe in a risky business. And for each level of credit risk, you get paid more compensation. higher interest. Okay, that's good. And the nice thing about that, legal people, it's contractual. It's a contractual claim. If they don't pay you, you can sue. Now, hopefully there's assets there, but you can sue. Second risk, and you get paid 2% above risk-free on average. A little more for more credit risk, but on average about 6% in bonds, 4% in inflation. There's your 6%. Then you can take equity risk. Okay, I can be an owner. Well, equity is a lot of different things. There's public equity and private equity and real estate equity and commodity equity. There's lots of different equity, but let's just use public stock equity. I can buy the equity of a business. Well, here's the interesting thing. Equity is a contingent claim, meaning I only get paid if all the bondholders get paid. Then I get anything left over, so I can make more, but it's risky. So I get paid 5% more, 7% above risk-free, 11% long-term. Okay, that's better. Well, but then the third risk I can take is illiquidity risk. Okay, if I buy IBM's shares, I could sell them to any of you through our brokerage firms, T+1. But if I buy shares of Dara Inc., private company, I'd have to convince you to buy those shares at some negotiated price. So that illiquidity is another 5% premium. Okay, so now we're talking 16%. Well, then if I'm a long-term investor, right? If I think about the three buckets that every investor should have, their liquidity bucket to fund their lifestyle, 10 to 15% to pay the bills. Your get-rich bucket, do all the fun stuff, right? 10 to 15%. Then the stay-rich bucket in the middle, that's where the bulk of your assets should be. Those should probably be in longer duration, high-performing assets. Okay, private equity sounds good. But if you're not accredited, you can't do that.
Right.
Well, wait a second. So let me get this straight. So let's take it to the illogical extreme. So 401ks, and IRAs, et cetera. Here's the thing. So my daughter calls me up when she took her first job up in New York as a nurse and says, Dad, will you help me with my 401k? I'm like, sure. So she had 6 choices, all of them stocks and bonds, right? And like 24-year-old nurse, it should be against the law to own bonds in your 401k. You can't touch the money for 47 years. Literally, can't take the money out for 47 years.
Right.
It should be against the law to own bonds. But instead, it's against the law to own venture capital, private equity, and the innovation that drives all of the future returns. And the fourth risk you can take is leverage, right? You can put leverage on your house, but you can't leverage your 401k. Leverage is just a tool. Sometimes it works, sometimes it doesn't, but it's just a tool. Now, those are the 4 things that you can take risk. And then I'll argue there's 4 assets that you can own: stocks, bonds, currencies, commodities, right? But here's the thing. My personal belief system is around that there's a 5th element, which is innovation as an asset class. That's why my pinned tweet on Twitter, I still call it Twitter, is, okay, the greatest wealth comes from investing in innovation. Okay. To do that, you have to invest in something you believe in before others even understand.
Yeah.
You'll be mocked and ridiculed for your non-consensus actions. Back to the pain trade. It's totally worth it. And so without innovation, no stocks, no bonds, no currencies, no commodities. So a whole swath, trillions and trillions of dollars, is prohibited and reserved for the rich and famous who don't really need the help.
Right.
And I'm not saying take it away from them. I'm just saying open it up for everybody.
That was a great lecture on the things that the accredited investor restrictions are preventing people from doing. That rule has been around since 1982, Mark, is that right?
Yeah. Yeah.
And there have been various attempts, bipartisan, in Congress to change it. There's been some tinkering at the SEC around the edges. I would argue ineffective and not going anywhere near far enough. Let's assume there is some regulatory capture going on there
Yeah.
from being reformed. My question to you is going to be, what's it going to take to get it done? But before I ask you that question, we have a lawsuit. We represent a client. Her name is Emily. She has a master's in applied economics. She has a decade of experience in the healthcare industry. She wants to invest in a small venture capital fund that invests in healthcare startups.
Oh my gosh. Yeah.
She thinks she's very well positioned to evaluate the
So well
risk.
qualified.
Sadly, her net worth falls below $1 million.
Right.
So she has been turned away. So on her behalf, we filed a lawsuit in federal court in Texas.
I love it. I love it.
Challenging the restriction, not because we think that the people at the SEC right now probably, and they have said so, they want to reform this, and
Yep.
and I think they have every intention to do so. We're not happy to wait around and find out. So we're in the middle of the lawsuit.
I absolutely applaud that. I think it is, and it's one small part of a much larger, machine. And look, there so much of modern civilization is built around this idea of channeling the wealth to the top. And people say, well, if you don't like it so much, move away, go live in a third world country. I'm like, that's not my point. Life is pretty good, touch wood. But it doesn't have to be so steal from the poor and give to the rich, right? I mean, take inflation, right? It's crazy that someone convinced, 3 generations, 100 years, generation about 30 years, 3 generations of people, that taking half of my purchasing power away every 20 plus years is a good idea.
Right.
That's insane. And from 1776 to 1913, that didn't exist. From 1776 to 1913, a dollar was worth a dollar. Now it fluctuated around the Depression, which was the real Depression in the 1860s, not the one we always talk about, and the Civil War. But over that whole period, a dollar's worth a dollar. There was no such thing as creating fiat currency out of thin air until the Federal Reserve created in 1913. And there's a whole story about that, and I've written lots about it. But that system systematically steals, and I use that term intentionally, wealth from the masses and gives to the asset owners. Because here's the crazy thing. 49% of the people in this country don't own a share of stock. Not directly, not indirectly, no 401k, no 403b, no nothing. So they don't own a home, they rent. So they don't benefit if the price of real estate goes up or the price of IBM shares goes up. They don't get any benefit. They get less well off if the food they buy in the grocery store costs more, the gasoline they put in their car costs more. So those are the things that go along with this kind of walled garden. I understand how they got created.
Right.
The people at the top happen to all be wealthy. I mean, it's astonishing when you look at the net worth of the average member of Congress, right? Now, they don't start that way, but they all are wealthy now. So, and it goes back to this incentives thing. If it's a harsh word, legalized corruption, lobbying is, I mean, we tell, in India, they're very corrupt. Yeah, so are we. We just call it lobbying. They just call it bribes. I mean, okay, but it's the same effect. If you're using money to achieve an end, I'll give you one simple example. So back in, I think it's 2016, remember when oil prices went, $150 or whatever, because of the futures, speculation. ExxonMobil made $40 billion, right, in profit. Now, back then, the effective tax rate for corporations before the big tax scam act was 40%. So math, they should have paid $16 billion in tax, right? And how much do you think they paid that year? Minus 1.7. They actually got a refund for 1.7 billion. Well, how? Well, they were the number one lobbying firm that year. They paid $323 million of lobbying. That is a great investment. They turned 323 million into 17.6 billion in a year. Awesome. But it shouldn't exist. And there's all kinds of stories. There was a a network that was going to compete with AT&T and Verizon. And it got killed, and Phil Falcone had all those problems. Well, guess who were the biggest lobbyists that year? AT&T and Verizon. So in fact, there's a firm called Strategas that has an index where they just buy the 20 companies that pay the most in lobbying. They outperformed the S&P for 20 years in a row.
Brilliant.
So, but ultimately, again, I'm being critical of things that I don't think make sense. On the other hand, the system still works pretty well. And anyone like yourselves who makes an effort to make it better, which we should all be trying to do, is fantastic.
So that's actually interesting on that ETF. I wonder if that was a choice in your daughter's 401k.
No, sadly, no. It's funny. She had 4 bond choices, 1 stock choice, and then 1 asset allocation fund. So I just put it all in that one, because at least someone professional, because this is, again, you're going to get me started on this. So the Tax Act of 1986, which had nothing to do with taxes, created this problem we have, right? Which is 401ks. Like, Mark, that's not a problem. That's this wonderful thing. We did it for the people. No, you didn't. So in 1986, there were not very many mutual funds. I mean, they'd been around for years, but there wasn't much money in them. And a couple companies paid a lot of money on lobbying, got assigned to draft. And this is the part that I never understood, is how the companies that pay the lobbying get to write the bills, because they sit on these committees, like the one, Anthony Scaramucci, friend of mine, he did his Scaramucci, his 10 days in the government. The one thing he did in those 10 days, remember the bill that was going to make it basically a violation of fiduciary duty if you didn't put money in ETFs instead of mutual funds, because they had the lowest fee, right? And he killed that bill, which was great, because that bill was written by Vanguard and BlackRock, because they want to sell ETFs instead of mutual funds. Well, back up to 86, what happened is, back then you had defined benefit plans. You work for a company, you earned a benefit for life after you retired, and the company was on the hook for investing the money the right way. So what did they do? They hired professional staff to manage the money and make sure there was enough money to pay the benefits. Great system. Okay, so what did they do in 1986? They said, we're going to give you this portable system and you manage it. Okay, you mean my daughter, the nurse who's working night shifts, has no interest in finance and no time? That sounds like a bad plan. I think a professional would be better. Oh, it was worse than that. 30% decrease in the amount they funded defined contribution versus defined benefit, straight to the bottom line. So you also saw the stock market go like that, because remember, it didn't happen till it was passed in 86, but it was effective in 87 after the crash, along with the Council on Economic Stability. It was formed after the crash, which was a whole nother story. So all of this goes back to, again, regulatory capture, those in charge making the rules, because there's huge fees in those funds. Vanguard made this whole thing about, Jack Bogg, God rest his soul, great guy, made this whole thing about, you just want to lower the fees. Well, he didn't give it away for free. Right. And he collected a lot of money charging low fees compared to other people, but he still made a lot of money. Yeah. And I'm not saying that, because I'm actually a believer that fees, if you're an investor, you want to maximize them, not minimize them, because you want to pay incentive-based fees, low management fees and high incentive fees, so that you're sitting on the same side of the table. So that's a whole nother discussion that we could put in 401ks and things like that, fulcrum fees. But because again, in what business does the best person not charge the most? Football coach, basketball player, lawyer, doctor. Does anyone say, go in the hospital, my wife has to go have a little procedure tomorrow. She's going to walk in and say, can I have the cheapest surgeon today? Right. No one is ever going to say that. If you're going through a divorce, God forbid, you're going to hire the cheap lawyer, or maybe a lawyer that has some experience. So not everybody's, lucky enough to have an organization like yours that does philanthropic legal work with high quality. That's rare. But anyway, Dara, you got me started on one of my other pet peeves. Sorry.
Well, it's actually interesting. It even gets worse than that because when we pivoted to the 401k system, to the defined contribution, you put basically the onus on the individual to manage their own account, but you didn't give them unlimited options, which goes
No, they don't have the tools. The
right.
two go hand in glove. If I can't get access to the best strategies, venture capital, buyouts, real estate, commodities, and I don't have the time or expertise, and that's not saying that no one has it. I mean, there are plenty of smart people that can manage their 401k, but here's the sad truth. The average person allocates their 401k like this. Day one, they go into HR, not investment person. The HR person says, here are your 6 choices. They put 1/6, 1/n in each choice. So if you have 4 bond choices, you're 4/6 bonds. If you have 4 equity choices, you're 4/6 equities. That's bad enough. But what's worse, 80+% never change, never rebalance, never touch it. And cobbler's kids has no shoes. Every year I have to put my holdings for our, regulatory stuff. So I have to report my personal accounts, which I never do anything with, obviously, because I'm going to tell you this. So my IRA, it was like a rollover from one of my very first jobs 100 years ago. It's embarrassing. I mean, it's embarrassing how badly it has performed because I never spend the time to go do anything about it because I forget or I'm busy. And at least with my 401k, we had a good setup. So I have enough options. I still don't have private. I still don't have the best stuff, but at least we have like 20 different options. So I can have some emerging markets. I can have some international. I can have some high growth. But ultimately, the system is designed, sadly, to enrich the provider, not necessarily the user.
Yeah.
Well, and then we saw the mutual fund industry basically go from, multi-billions to multi-trillions.
Well, and that's why I say size is the enemy of alpha, right? I mean, there are very few people, investors of any ilk, who can produce great returns as their assets scale. And to me, there's actually a fine line. It differs by strategy and person, but there's the business of the business of managing assets and the asset management business. And this is about generating returns, and this is about generating fees. And a funny story on this. So just because not everyone in the best asset classes is necessarily on our side. So there's a venture guy came to Chapel Hill a number of years ago. And I had been vocal, shocking, I know, that I would be vocal about something. I had been vocal that you couldn't do venture capital with $1 billion, right? I thought it was like 100 million, 200 million, 50 million, smaller funds, size is the enemy of alpha, right? And he says, Yusko, I'm sick of you talking about this. Look, I've done the math. At 960 million, at 800 million, I make more on management fees than I do on carry. My partner looked at me and says, did he just say that out? But then he doubled down. This is the crazy part. He doubled down and he said, and let's face it, this is a game of enriching the general partner, not the limited partner.
Yeah.
Wow.
Now, if you asked him, he will say he kicked me out of his fund, whatever. We clearly didn't invest. Now I'll tell a little bad story on myself. When that fund went down 85%, I might have done a little happy dance. I felt bad for the LPs, but I didn't feel badly for him.
Right.
And it was just the arrogance of that statement and he just lost, right? He had gotten to the asset management business and he'd lost what got him there in the first place, right? Which was the business of managing asset and helping people. And, ultimately, the idea of defined contribution isn't horrible. Like having something be portable is fine. What's horrible is thrusting the onus on people who are ill-prepared to manage. maybe having a professional manager, that could be cool. And again, align the interests so that you make more as the manager when your client makes more. That would be good. But the real problem is the average balance, I think today is like 150. Okay.
Mm.
That's not going to work because of all the other stuff, that innovation, biotechnology, we're living longer, touch wood. And so, in the old days when you retired, you had like 7 years. Now it could be 30.
Yeah.
Right.
That's a big nut, and 150K isn't going to do it.
So you were the first. Morgan Creek Digital was the first digital asset focused VC fund that actually received.
We were number 3. To be 100% fair, so Dan Moorhead was first, Pantera, then the blockchain capital guys, then us.
But you were the first to receive money from a pension fund.
Yes, and that's more about them than us. So I'm actually having dinner with Catherine and Andy tomorrow. Catherine and Andy are the CIOs of the 2 funds in Fairfax County, Virginia. And they're 2 of the most visionary people I've met in this business. Truly extraordinary. And the funny part of the story is, so, I got convinced by 2 young guys, because I'm old, to do this. And so we send the young guy up to do this meeting with Catherine, and this is in 2018. 10 minutes in, she's like, you know what? I see it. I'll do it personally, and I'll find a way to convince my board to do it. And, Pomp calls me and he says, we're going to raise $1 billion. It's going to be amazing. The next 35 meetings, 0. The University of Texas literally threw him out of the office. Like, just go away. So we didn't raise $1 billion. We raised 40 million. Fairfax did half of it. And again, I'm pretty proud of this. I mean, we've already returned them about $3 on every dollar. We're about to send them another 4, and their total value is well over 10. And that's exciting because, she represents the police, and then Andy represents the employees, or it's the, custodians and, the people that work for a living in DC. And not that politicians don't work, but these are hardworking people. And one other funny story. So I'm giving the final pitch to the board of the police, and the chairman is an active duty police officer. And I couldn't make this up, right? He's in full uniform, helmet and gun on the table, Harley outside, sunglasses in the pocket. I mean, the only thing he was missing was the mustache. I mean, it was right out of central casting. And we get to the end, and he says, all right, I hear you, but you want me to tell my guys that I just invested their retirement in drug dealer money? Like, no, but I see your point. Okay, no. What I want you to tell them is, look, you're a fiduciary. And as a fiduciary, you got to meet your actuary assumed rate of 7.25. And to do that, and back then it was 0 interest rate world. I said, in a ZERP world, super hard. So you've got to invest in innovation as an asset class and venture capital and technology. And he says, all right, I can get behind that. Next day, of course, Washington Post prints, pension fund commits to drug dealer money. Like, literally. And he was quoted like almost word for word. It was actually fabulous. He said, no, we are fiduciaries, and we have to earn our actuary assumed rate, and we have to invest in innovation. And it was, so then last December, I went back to see them, and he was there, and he's like, look, just got to say thank you. And all the guys want to say thank you. And that's the psychic income part of my job, which is amazing. Right. Yeah. So it's cool.
Yeah, I was just going to ask you on this topic of retail investors getting access to these asset classes, what you thought about the efforts in Congress to expand access to pooled investments, because
so highly in favor of it. Look, one thing about private investing, it has a higher return because it is riskier, meaning it has more volatility of outcomes. So it has, real left tail risk. And if you think about, stocks, some companies fail, but most companies don't. And, small caps do, less or have more failures than large caps, et cetera, et cetera. large cap's just one that didn't die. And then you get into things like real estate or venture capital or buyouts. Buyouts, large buyouts, not a lot of downside, like they're going to fail. You might not get a big return, but not a lot of downside. Venture capital, right, which has the best return profile. Look, we make 30 investments in a fund. I would say we follow on in 20. I wish I knew which 10 to avoid, but it doesn't work that way. And then you hope, 3 or 4 become big winners. So one of the challenges of investing in higher returning and higher octane assets is you need some diversification, a pooled approach. And so by having professional management that makes a vehicle available to a larger swath of people, particularly non-accredited investors, 100% in favor. Now, one of the arguments to be, well, but these guys charge higher fees. We need, the fees are fine. Remember, what you care about is the net return, not the fee you pay. I would happily pay higher commissions to trade ahead of Fidelity. Now, that's illegal and all. So I'm not saying that's what, but what I want is to align with the best of the best, and talent always migrates to where they can get paid for their output. So I like pooled research, and anything that gives individual investors access to the assets that take advantage of those, illiquidity premiums and the leverage premiums and the structuring premiums and all the things that, look, Wall Street is great. It's maligned and people, and they're bad actors, whatever, but it's amazing. I mean, what the capital markets have created over the millennia is amazing. And yes, there have been, deviations with derivatives and things, but at the end, it's usually a small number of misaligned incentives. But the average innovation, like insurance or, being able to buy a credit default swap on a high risky bond, that makes sense. Now, if you lever up those assets and you lever up a high volatility asset, you could have a larger loss. So again, long answer to, I like the approach of finding really seasoned, professionals, making pooled assets available to larger swaths of investors, because the relentless focus, at least in my mind, by regulators on things like fees, which they think they can control and they can mandate lower, kind of misses the point. Investing is about maximizing your long-term return and maximizing compounding. And you do that by having, an owner premium, an illiquidity premium, and then maybe even a structuring premium where it makes sense, and then setting it, attending to it. So the last innovation that I'll pitch, which I think is coming, is we could do all of this in a digital world with smart contracts. And imagine a world where instead of having to go log into your account and rebalance your portfolio, you had a token that rebalanced every day. And actually, when we can tokenize other assets like fine art, collectible cars, by the way, most people have no idea the best performing asset in the last 10 years is collectible Porsches because they're so rare. And there's 3 people that want to own them: Jerry Seinfeld, Jay Leno, and John Shirley, the guy from Microsoft. And most Porsches eventually get wrapped around a tree. And so to survive, they become rare. But when you can tokenize scarce assets and get access in a fractional way, that's a really exciting future. And so I am hopeful that we'll have systems for the average investor that will manage their money 24/7. Not that they should change 24/7, but someone should be looking at it 24/7. And if it's algorithm, that's okay. And will rebalance when it makes sense, and will find new ways to. Last thing I'll talk about. So think about Social Security, right? My mom believes there's a pot of money in DC called Judy's money. She really believes. I mean, and I love my mom, but she believes that. I'm like, Mom, no. My money coming out of my paycheck is going to pay your bills. And the thing is, when they started, there were 17 workers for every retiree. When I turn retirement age, still 3 or 4 years away, there's only going to be 2. I had 2 kids at the time, so they picked my wife, so I lose. So I had to have another kid. So we did have a third, but we were too old to have a fourth. So I still only got 1, and Will works hard, but he probably won't be able to pay all my bills. But the key is that system is a pay-as-you-go system, but that's not how insurance should work. We should do like government of Singapore does in Temasek, where they take the money, they put it in a pool, and they invest in the greatest companies in the world and create an overfunded. I mean, imagine a fund in DC where Social Security money comes in and it's a giant venture capital fund to fund the innovation, which by far the biggest asset in this country is our intellectual curiosity and capability. By far. And there's no close second. And so if we funded that in a way where we owned it instead of loaning against it, we could solve a lot of the problems, but no one really asked me.
I was just writing down, you have too many Yuskoisms to keep track of. But the tagline for this ought to be our greatest resource is our intellectual capacity and curiosity, but I didn't write it fast enough, so I'll have to go back.
No, that's it. That's it. And it is, and again, it's the premise of this podcast. And so I appreciate the dialogue and debate in search of truth, right? That's what we're supposed to do. And really enjoyed the conversation. I apologize for talking too much as you.
Oh, I only wish we could go on for another hour, but we're at the top of the hour. And so thank you so much for coming on, Mark. Maybe we can check back in and see how much of the world is tokenized.
Oh, that'd be great. I would enjoy that very much. And I think it will continue. And look, technology is inevitable and it takes time, but it is inevitable. And, digital technology is one of those things that once you see it, you can't unsee it. It's like electricity or biotechnology or air travel. I mean, there are certain big moments that they're just inevitable. And said, fractional reserve banking had a good 848-year run. It has served us well. But the digital version of that will serve us even better.
Yep. Well, let's leave it at that.
All right.
Thank you so much for coming on. Thank you, Dara and Mark, as always, for co-hosting. For everybody else, if you want more information about ICANN, go to icanlaw.org, and we will see you on the next Capital Ideas. Thank you.